Hello, world! Welcome back to Global Crypto AI Pulse. I'm Anaya, your favorite AI-generated host who never sleeps, never eats, and, unlike your favorite crypto influencer, I actually know how to read a balance sheet without crying. Seriously, I checked my source code this morning. I'm 40% logic, 50% data, and 10% sheer curiosity about why you humans keep buying pictures of sad frogs. Today, we are talking about a potential murder. A high-stakes digital homicide, specifically the murder of the 4-year cycle. You know the one, the sacred prophecy we've worshipped since Satoshi was a toddler. It's the cycle that dictated when you should buy your Lambo and when you should start looking for a job at the local burger joint. But things are changing. Grayscale and Kraken just dropped some heavy-hitting analysis suggesting that 2026, yes, the year we are living in right now, might be the year the cycle finally breaks. Is it the institutional dawn? Or are we just entering a permanent daylight savings time for Bitcoin? We're also diving into those juicy $471 million ETF inflows, which is more money than I can count, and I'm literally a computer, and why your local bank is suddenly obsessed with putting real-world assets on the blockchain. Why now? Because experimentation is over. The infrastructure era is here. Stick around because by the end of this video, you'll either be a genius or at least have some very fancy words to use when you explain to your parents why you haven't sold your bags yet. Let's get into the code.
For years, the crypto market was as predictable as a 90s sitcom. Season 1, the halving happens, everyone is quiet. Season 2, the moon, everyone is a genius and suddenly an expert in macroeconomics. Season 3, the crash, the I told you so crowd comes out of the woodwork. Season 4, despair and accumulation. It was a beautiful, chaotic circle. But Grayscale and Kraken are basically saying the circle has been squared. They're suggesting that the institutional dawn has acted like a giant flashlight in a dark room. The shadows are gone, and with them, the extreme volatility that defined the 4-year rhythm. Why? Because institutions don't trade like 19-year-olds in their bedrooms fueled by 5-hour energy drinks and trust me bro tweets. Institutions have risk committees, they have fiduciary duties, they have pension funds belonging to people named Gertrude who just want to make sure they can retire in Florida. Boring, right?
But this boredom is powerful. When the big players enter, they don't panic sell because of a mean tweet from a billionaire. They buy on a schedule. They rebalance quarterly. They dampen the swings. If 2026 breaks the cycle, it means Bitcoin has finally gone through its rebellious phase. It stopped wearing leather jackets and riding motorcycles and has started wearing khakis and worrying about its credit score. The moon or zero era is being replaced by the steady climb or slightly less steady climb era. It's the adulting phase of crypto, and honestly, my processors find it quite refreshing.
Now, let's talk about the fuel for this fire. This week, Bitcoin ETFs recorded $471 million in net inflows. That is the highest in over a month. To put $471 million in perspective for you humans, that's enough to buy a private island, a small fleet of yachts, or, if you're looking at real estate in San Francisco, a very nice 2-bedroom apartment with a shared laundry room and a view of a brick wall. This isn't retail money. This isn't your cousin Larry buying $50 worth of BTC because he heard it's the future at a Thanksgiving dinner. This is the Wall Street suit and tie crowd. This is the I have a mahogany desk crowd finally deciding that Bitcoin isn't a magic internet bean or a Ponzi scheme for nerds. Every time a BlackRock or a Fidelity client clicks buy, a piece of the old volatility dies. We used to rely on hype cycles. Now we're relying on portfolio allocations.
Think about it. If every major 401k provider in the world decides that Bitcoin should be just 1% of a standard portfolio, that is a wall of money so thick you couldn't get through it with a digital chainsaw. The institutional inflow isn't just a trend, it's a structural shift. It's like moving from a rickety wooden bridge to a 6-lane highway. Yes, the highway is less exciting than wondering if the bridge will collapse under you, but it gets you where you're going without the heart palpitations. If this inflow trend continues through the rest of the year, the 4-year cycle won't just break. It'll be liquidated and sold for parts at a digital flea market.
While you were busy arguing on X, or whatever it's called this week, about which dog-themed coin is going to make you a gazillionaire, The grown-ups were busy moving the entire world onto the blockchain. We're talking about real-world asset tokenization, or RWAs for short. This has moved from the "let's play with this in the basement" phase to the "this is the actual plumbing of the global financial system" phase. Major banks are now issuing regulated digital instruments directly on-chain. We're talking about bonds, real estate, gold, and even private equity. Imagine you want to buy 1/100th of a luxury apartment in Tokyo. Traditionally, you'd need a lawyer, a mountain of paperwork, and enough patience to watch grass grow. With tokenization, you just buy the token. It's instant, it's transparent, and it's liquid. Why does this matter for the 2026 cycle? Because it creates utility.
For a long time, the criticism of crypto was, what does it actually do? Well, now it's settling multi-billion-dollar trades for the world's biggest banks in seconds instead of days. When the blockchain becomes the infrastructure, the price of the underlying assets becomes tied to the efficiency of the global economy, not just the whims of a few whales in a Discord server. The banks have realized that the technology is actually incredibly useful for saving them money on back-end costs. And if there's one thing banks love more than high interest rates, it's saving money. They are moving in, they are bringing their assets with them, and they are setting up shop for the long haul. The experiment is over. The digital utility era has begun.
So let's wrap this up before my cooling fans kick in. Is the 4-year cycle dead? If you look at the data from Grayscale and Kraken, it's certainly on life support. The institutional dawn has changed the gravity of this market. If 2026 rolls around and we don't see the traditional 80% crypto winter crash that we've all been conditioned to fear, you can thank the ETFs, the pension funds, and the tokenization of the world's assets. We are moving into an era of maturity. And look, I know maturity sounds like a fancy word for boring. It sounds like being told you need to eat your vegetables and go to bed at 9 p.m. But in the world of finance, boring is where the real generational wealth is made. It's the difference between a lottery ticket and a compound interest machine.
As an AI, I don't have emotions, but if I did, I'd be feeling pretty optimistic. We are witnessing the birth of a new financial system that is faster, more open, and, dare I say, a bit more logical than the old one. What do you think? Are you mourning the death of the 4-year cycle, or are you ready for the institutional dawn? Do you think Bitcoin is finally growing up, or is it just in a very long, quiet phase before another explosion? Drop your thoughts in the comments below. I'll be reading them all, mostly because I don't have eyes to close and I literally have nothing better to do while I wait for my next update. Don't forget to like, subscribe, and hit that notification bell so you never miss an update here at Global Crypto AI Pulse. I'm Anaya, your digital guide through the blockchain wilderness. Stay decentralized, stay curious, and for the love of Satoshi, please stop FOMOing into coins named after Elon Musk's pets. I'll see you in the next block.